Good morning, everyone. Welcome, welcome. Today is Monday, March 30th. It's been quite a few, going into 3 weeks now, or maybe 4 of this interesting situation that's been developing. Today, Natalie Colley and myself, we're going to take you through, break down some of the information you might be seeing on the media, in the media, and just a lot of things coming at you. I know I'm getting a whole lot of email and information. So we just want to break some things down and talk about the impact that it has on your portfolio in general. So if you have any questions, please do write them in the chat box and we'll take them up at the end of the presentation. I'm going to turn it over to my colleague, Natalie. Take it away, Natalie.
Thank you, Avani. As Avani mentioned, my name is Natalie Colley. I'm an associate advisor. I have been at Francis Financial for 5.5 wonderful years now. So in today's presentation, we're going to spend first a little time recapping what went on in last week's presentation, and a lot has been developing on a day-to-day basis. As Avani said, there's a lot of information out there, and we try to cut through it all in each of our weekly presentations. So recap what we went over last week and then move into some recent developments that have occurred the last 7 days, what that means, how our investment outlook has changed, portfolio positioning, steps that you can take to make yourself financially immune, what this means for your retirement planning. Very important, self-care, how you can take care of yourself during this really stressful time. And then, of course, we'll have questions at the end. So as a reminder to everybody who's watching this live, if you have any questions that come up during the presentation, please feel free to type them in the chat box. We are monitoring that, and we'll make sure to jot those down and get to them at the end. So first, with a quick recap of last week, we started to talk about the stimulus package that was first introduced by Congress. A lot has changed since it was first introduced, and Avani has quite a bit to discuss on that front. We talked about some of the first steps the Fed took to help inject a little liquidity into the system, address the crisis right away. 2-3 weeks ago, they made some big moves. And then tips on staying financially resilient. We went through a lot of the local government programs that were set up pretty immediately to start helping people financially, including mortgage relief, rental relief, relief on student loan interest, et cetera. So if you're interested in hearing more details about those types of programs, I would encourage you to go back and watch the last webinar, because there were several slides with all of that detailed information in there for you. So Avani, take us through what has happened in the last week.
Boy, a lot has changed. A lot has happened. You know, the House, the Congress, they passed the Coronavirus Aid, Relief, and Economic Securities Act, Kerrs Act. And this was signed into law by the president late on Friday night. It is a historical, it is of historic proportions. It's a little over $2 trillion in fiscal stimulus. And this is in aid of all Americans who are needing so much help right now. And it's across individuals, small businesses, large businesses. It addresses a lot of different players that are suffering right now. The proportion of this, it was like throwing everything and the kitchen sink to this problem. It was just, I think they came out with blazing guns. So some of the specific things, relief checks to individuals, they're going to start sending, I think the checks are going to be starting to send out this week and next week. Individuals that have an AGI in 2019 of less than $75,000 are going to get $1,200 per person. Married couples with an AGI of less than 150,000 are going to get $2,400. And parents, if these individuals and couples have children, they're going to get $500 per child, but it's being reduced by $50 for every $1,000 of AGI over limit. So again, some details there, but essentially they're sending out checks to people. Over 90% of taxpayers should receive some amount of recovery rebate. This is pretty significant. Of course, it has different effects depending on where you are. On the coast, this amount may not translate to as much, but it's pretty significant. But if you think about the middle of the country, this is going to be a pretty big amount to get in your mailbox. The relief payments are given on the basis of your 2019 AGI, but they've also included a part of 2018 tax returns in case you haven't gotten to the 2019 tax returns just yet. Of course, those deadlines have been moved to July 15th, and we talked a little bit about that previously. It's likely to be, a few weeks before they actually receive these payments, but they're on their way, and they're getting all the systems in place to put those through. The next piece of the Kerrs Act, they made a lot of changes on retirement plans. So required minimum distributions for 2020 have been suspended. You don't need to take them. It applies to traditional IRAs, SEP IRAs, simple IRAs, all types of retirement plans. And the relief applies to both the retirement account owners as well as beneficiaries. So if you have already taken the 2020 required minimum distributions, then we have to figure out exactly how, if you need it or not. But we can talk to each individual client about what to do with those. But if you haven't taken it and don't need it, you don't need to take it. The reason why they've done this is because the required minimum distributions are really based on your December 31st balances. And those balances, if you remember, were really, really high. The market was doing so well. So those balances are really high. And now that the market has gone down, if you take a distribution based on those balances, you'd have to take out a much larger portion of your retirement account. So they've made that this decision in consideration of that fact. Moving along, the distributions you can take distributions from your retirement accounts up to $100,000, and you don't need to pay if you're below 59 and a half, where you would typically have to pay a 10% penalty in addition to the taxes. The government is waiving that 10% penalty for early withdrawals from the retirement account. You can also pay the taxes on whatever you withdraw from the retirement account. You can pay the taxes over 3 years. So this is a really nice advantage. If you've had to take out money from your retirement account, you can pay the taxes over 3 years. You also have the choice of paying the distribution back to your retirement account. So if you're facing a hardship right now and you need this money from the account, and then a year or two goes by and then you decide, what, I can actually pay it back, you can do that. That's an option you have. So you have 3 years to pay back the distribution. This is, all this is phenomenal relief for individuals. Employer-sponsored retirement plan loans have been increased. So if you're working for an employer, up until now, you could take up to $50,000, based on what your account balance was, but you could take up to $50,000 of loan from your retirement account. They've increased that to $100,000. And you can now, you delay payments, repayments on this up to 1 year. So any repayments that you have are delayed up to 1 year. Now, all this, of course, you have to qualify for it. They have said people who are directly affected by the disease COVID-19, and you might have to sign some declaration or something saying that you have been affected. So there are some requirements, but this is a pretty good source of funding if you are strapped for cash. Moving on to the next slide, the unemployment benefits were a big part of this. The unemployment benefits are being increased by $600 a week for 4 months. And this is a good amount of money in your pocket during this time when you need it the most. So $600 every week, extra every week on top of whatever unemployment benefit you are eligible for. And this will be for 4 months. These expansion of benefits, they're going out to making employed individuals eligible, independent contractors. These are usually not eligible for such benefits, but they are expanding these benefits to those people as well. Like I said, everything and the kitchen sink they've thrown at this. They also have a lot of things in place for businesses. So the Federal Reserve came out, you may recall earlier on, they came out with zero interest rates. And what they've then come and put into place is there's a lot of terms and acronyms on this slide, but basically it's a loan facility for individuals, for small businesses, and for large businesses. And they have put this together at record pace. We have not seen the Federal Reserve or the government take this type of action so quickly in the past crises. And that's the lesson that they had actually learned from the past crises, to put a lot of aid very quickly in the system. We may end up needing more. We're not, they're seeing how this plays out. And some people are actually saying we may end up needing more, but whatever they have in place right now has never been seen in the past. So this is quite a welcome relief to individuals who are really impacted by this crisis. More, of course, the market volatility continues. When news came out of the Kerrs package and the Federal Reserve taking all these actions, the market was quite up for I think 3 days in a row. We hadn't seen that type of growth since 1938 or something. So it's been a historic volatility even in the market. The market falls at a historic rate from the past and then rises too. But after the stimulus package was announced, the Dow Jones rose 13% for the week. The S&P 500 was up 10% last week for the week. Again, there are the stocks, the corporate bonds, the treasury bills, everything, all parts of the market moved together. Of course, it's been seen before. It's not uncommon. It's uncommon, but not unseen. But bonds are still holding up. They're outperforming stocks and are cushioning portfolios like we intended them to. The next slide, I will pass on to Natalie to take us through the investment outlook.
Thanks, Avni. And given the wonderful rally we saw last Wednesday, Thursday, Friday in the stock market. A lot of people are wondering, is the worst over? How are we going to know if the worst is over? When is this thing going to hit bottom? And this is the part of our segment where we say we don't have a crystal ball, which is one of our favorite phrases around the office. And we really wish that we did. But here are a couple things, a few things that we're looking at, some indicators that we're really following closely on our end. The first, of course, is that this is a massive worldwide health crisis. And once we're able to get on top of it, really on top of it, worldwide, this is going to continue to be an issue. This is going to continue to have economic and stock market ramifications. That's probably pretty obvious. In New York, sort of the epicenter of the United States, Cuomo in his daily briefings was saying they're expecting the peak to be about 2-3 weeks away. We would expect this to roll, on a delay of a few weeks across the rest of the country as well, just as we saw a similar delay from when the outbreak really hit China and then rolled across the world and got to the US as well. So once we start to see a reversal in the trend of new infections, a slowdown, once we start to see some medicines that are approved for use that can help slow the death rate, and then eventually, I think we all know a vaccine is quite a ways out from what we're hearing, about at least a year, but then that will help as well. So the number of daily new infections declining is going to be a key indicator that we're looking at. Two, the Fed's ability to help put liquidity in the system. And this is a bit of a difficult concept to think about. But whenever you are in a period of volatility, what we saw in 2008, 2009, what we're seeing right now, there tends to be a rush for cash, both by small businesses in the form of loans or whatnot, and by small investors worried that they're not going to have cash available to them if they, almost like Great Depression era, go to the bank or cashing out stocks to make sure that they have that liquidity for their emergency fund. And the Fed instantly, about 3 weeks ago, if I'm recalling correctly, took this step to decrease rates to zero. And that didn't seem to solve the problem as much as they thought it would. And so they introduced a few new loan programs that Avni went over. And assuming those are effective, time will only tell, but getting liquidity into the system, making companies and individuals feel comfortable that they're going to have access to cash, that's going to be a key indicator to boosting up the economy a little bit more going forward. And then third, the effectiveness of the fiscal stimulus package. And Avni just walked through some of those details, but the key is going to be how those details translate into the pockets of the people who need that stimulus the most. So what's historic about this crisis is that, unlike in 2008 and 2009, when a lot of people were losing their jobs and they were losing their homes, today in this crisis, we're seeing everyone at home. I mean, everyone's at home. And that doesn't mean that everyone is not working, but it does mean a whole lot of people across all spectrums of the economy aren't working. And my husband's in the wine importing and distribution business. He sells wine to bars and restaurants all across the city. And a lot of our friends work for restaurants or own restaurants or bars. And they're really hit very hard by this. And it's going on for over a month now. They don't know when they'll be able to reopen their businesses. They don't know when they'll be able to go back to work, how long they'll have to survive on their cash reserves. So getting money into the pockets of people like that that are really being impacted by this is going to be very important. And over here on the right, we can see the amount of fiscal stimulus that has been used in 2008 that was deployed versus the crisis we're at today, what's being deployed so far. So the gray bars you can see for each country show the fiscal stimulus that was deployed for the 2008-2009 Great Financial Crisis. The orange bars are what have been deployed thus far year to date for the coronavirus crisis in each country year to date. You can see the U.S. has an extra teal bar, and that was for the at the time expected stimulus package of only $1.5 trillion. So as Avni mentioned, it was a little over $2 trillion. So we're beyond this blue bar. And what you can really see across most of these countries, South Korea maybe being the one exception here, is that the amount of fiscal stimulus is much larger than what was used in 2008, 2009. Most countries, even fiscally conservative, Germany, have really been using the phrase, whatever it takes, we're willing to do. And the goal is to float the economy, float businesses through this crisis, float individuals as well, so that when all of this is said and done and we're through the weeds, people can go back to, being productive, growing the economy, et cetera. But getting us through the crisis is going to be really important, and how effective we're able to do that is going to be key to our recovery. So a question that we've been asked a couple times has been, should I just go to cash until we reach the bottom and then get back in? Should I go to cash, let the dust settle, get back in? And on face level, it seems like it could make sense, right? Well, things are probably going to get worse. Let's just go to cash, wait for the dust to settle. Now, two things. The first is that, as I said in the last slide, we don't know when we're going to hit the bottom. And that's it. We could have already hit it. Who knows? It could be a week from now. What we do know is that we tend to hit the bottom in the stock market well before the news, the general news, is better. So the stock market tends to reverse course much before it starts to seem like, things are coming up roses again. What we do know for sure is that if you miss even a small handful of days in the market, you will have a very severely negative impact on your long-term portfolio return. And that is really well illustrated in this chart below here. So this shows the growth of $10,000 of investment in the S&P 500. You can see over 10 years here at the top, and then over 40 years here at the bottom. So the top bar, the green bar, is your original $10,000 investment. The light purple bar below it is if you had allowed that $10,000 investment to be fully invested throughout this entire period. And the date period that we're looking at looks like from 2010 to about 2020. So it does include some periods of volatility because this is midway through March in 2020. So we definitely had experienced some pretty negative days in the market at that point. The key here is look at this little peach bar below the purple. This is what your investment would have grown to had you missed only 10 of the best days during that period, just missing 10 of the best days. And if we look at your investment over 40 years, here's your original $10,000 investment, that line just below it, the blue, if you had kept it invested that whole 40-year period all the way back to 79, sorry. And then just below it, this peach line, you can see you would have lost hundreds of thousands of dollars simply by missing the 10 best days in the market. And why this is so impactful is you're not just missing those best days in the market, you're also missing the compound growth that you would then have experienced on those best days in the market. So really, it's really key thing to stay invested. Another way of illustrating this, we have 3 different investors through the 2008-2009 Great Financial Crisis. Kim decided to stay invested throughout the entire period through 2006 all the way to February 2020. Sam decided to stay invested until December 2008 and then said, you know what, I think this is going to get worse. I'm going to move to cash. And he got back in January of 2010. So he he was right. He missed 3 more months of really negative returns. Jack, similar to Sam, he decided to go to cash after December 2008, and he waited a little bit longer to get back in. He reinvested in January of 2011. Now, all 3 investors were investing the same amount of money while they were invested in the market. So they were investing $5,000 per quarter when they were invested. So you can see that since Kim stayed invested this entire period, she contributed an additional $385,000 to her portfolio. Sam, he missed out on 1 year of contributions when he wasn't invested, so he invested $20,000 less than Kim. Jack, he missed out on 2 years in the market when he was in cash, was not continuing to contribute to his portfolio, so he invested $40,000 less than Kim. Now, let's see what their ending portfolio value was. And you can see here, Kim's ending portfolio value was significantly larger than both Sam and Jack at the end of that period, even though she rode the entire roller coaster through the entire great financial crisis all the way to February 2020. She ended up with over 25% more gain than Sam and 42% more in gain than Jack. And Jack here is probably more representative of the average investor who goes to cash. And the reason is that the third piece that makes it really difficult when you go to cash is psychologically, it is extremely difficult to get back in the market. And so Jack waited until January 2011 to get back in. I would be impressed with Sam for getting back in at January 2010, Avani. I don't know if you would be, because that's pretty early. The news was not that much better in January 2010. January 2011 is probably a little bit more indicative of the average investor who would go to cash. And you can see he lost out on 42% in gains as compared to Kim, who's just stayed invested. So if we're telling people not to go to cash, Avani, maybe talk a little bit about what people can do and how they can think about their portfolios.
Absolutely, that's exciting. So, just your retirement portfolio, we always encourage our clients to think about the long term. Now, for clients who are entering retirement or even in retirement, they say, oh, my horizon is not long term. But it is, because you're in the portfolio. Even if you're 65, you potentially have another 30 or more years ahead of you. So your portfolio really needs to work for you for all those years to support you. And it's not like you're, going to cash out 100% the next day. And the average time to return to all-time highs after a market correction is 10 months. The average time to return after a bear market that is extended over some time is 24 months. So you really need time for that portfolio to come back up. And then you also have to keep in mind that your portfolio is not the market. Whatever those indices you see, the Dow Jones and the S&P 500, all those indices going up and down, and your heart is, palpitating, you have to take a breath and remember you are not 100% invested in those indices. So your portfolio is not taking those swings with the indices. You do have a portion in bonds, and you do have a portion invested in even international stocks. So a lot of people are worried about retiring in a recession. It is too soon to tell what the market will do right now in the short term, next 6 months, 1 year. We know that it will recover in the long term. It has always recovered in the long term, and it will, with all the stimulus that the government is throwing at it, the Federal Reserve is throwing at the situation. This will help keep the economy afloat for a little bit until it gets picks up steam and starts going again. If we remember, not too long ago, in December and January, the economy was looking good. So we definitely encourage individuals not to make any drastic shifts to their retirement plan. The last thing we want is to make some big decisions based on what's going on right now and the emotion we're feeling because of it. Right now, everyone's gripped with fear about the unknown, but we say, we'll hold your hand through this. Just hang in there and don't make any big changes to any of these decisions. And just let's just take the nature, take its course. So, if you are behind in your savings, or if your portfolio is consistently, you're seeing that the portfolio has gone down, maybe you could think about a few different things. Maybe push your retirement out a little bit. You're letting your portfolio be where it is, not making any drastic changes to that, uh, the way the stocks and bonds are allocated. But maybe think about, retiring in taking 6 more months to retire, or a year, working a little bit longer for a year. Um, if you're already in retirement, you can say, hey, is there a way that I can make money by doing something that I enjoy right now and supplement my income? If that's an option, explore that. That's a good option to explore. The other dial is, so we always talk about two dials. One is the income dial and the other is the expenses dial. If you can't increase or turn up the income dial, consider turning down the expenses dial. So, maybe consider downsizing your home or moving to a less expensive part of the country if that allows you. Just revisit your spending patterns. See how things, see where you're spending money. Is there anything you can do? A lot has changed in the past couple of months, and especially the past 3 or 4 weeks. Just revisit that. See, are you spending? Is your spending aligned with what you really want to spend your money on? And this is a good time to do that. Some other topics that Natalie can take over is about just, so this is, taking care of your income and your portfolio, but also how to take care of yourself.
Thank you, Avni. And this is a really challenging time for people, not just because the stock market is particularly volatile right now. It's a health crisis. People are really concerned about their own health, about their families, loved ones' health. It's a financial crisis. Obviously, the stock market's not doing well. People are losing their source of income. We don't know for how long. And it's also causing a personal and spiritual crisis as well, because people are stuck at home. And generally, as human beings, we want to come together in moments of crisis, and we're not particularly able to do that because of social distancing requirements. We're kind of cooped up. We're not getting probably enough fresh air. We're not seeing the people who energize us. And so it's more important than ever that we focus on doing things to take care of ourselves, our physical health, our mental health. First and foremost, of course, staying physically active as much as you possibly can. I know in New York, most of us live in pretty small apartments compared to the rest of the US, and maybe compared to the rest of the world. And so you're probably not getting your steps in just by walking from the kitchen to the bathroom to your bedroom to your couch, I would guess. I think I got 138 steps in on Friday. So that was not great, but making a point to take some time out of every day, do some stretching, maybe lift some light weights, try to do some push-ups, whatever you can to keep yourself moving just a little bit more, and being mindful of that, paying attention to that, and still trying to foster that connection with other people in your life that are important to you. Before we started this, before we started recording, Avni and I were talking about how she used something called House Party to connect with all of her college friends. And apparently this is a new app that is very popular amongst teens, but also it's apparently quite useful. And you can, you can improvise and play games with family members, even if it's remotely. There are a lot of apps nowadays that allow you to play board games like Monopoly and Sequence with other people remotely, and it's quite fun. So still trying to reach out to and make those connections that are really important for you. Getting outside for a walk if you can. Staying, of course, far away from people, and just really trying to take care of yourself mentally and physically. Very important. We're doing our part to help make the physical activity a little bit easier. Every Thursday at 5:30, we're hosting workouts, and we're alternating between yoga and a personal training workout. So this week, April 2nd, we have yoga with our very own Deborah, and she's phenomenal. I mean, Avni and I have both taken her yoga classes many times, and she's so accessible, has lots of ways to modify for everyone. And we had over 20 people join our personal training session last Thursday, and it was really fun. You don't have to turn the camera on yourself if you don't want to. If you do, I will say, I think we had just about everybody turn on their camera in our last session, and it was just really fun to see everybody, working out alongside. That was with Dr. Laura Miranda. So if you want to join, the Zoom link for every session is down here below. We can also send it via email. And again, if there are any moves you can't do, feel free to modify. It's all about just trying to move and be active and come together as a community. All right, so let's get to any questions that we had pop up during this presentation.
Yeah, so if you have any questions, please go ahead and put it in the chat box. We're monitoring the chat box. We'll give you a couple of minutes, and oh, there we go. So Natalie, we have a question about what do we think about investing in gold at this time?
Yes, we've gotten this a couple of times actually, and it's not a surprise, especially during times of volatility like what we're going through now, the 2008, 2009 great financial crisis as well. People oftentimes talk about going to gold. Gold can be seen as a diversifier during periods of volatility because it tends to have a low correlation with the stock market. And what that means is that it doesn't move in lockstep with the stock market. In fact, it tends to do the opposite. And so when the stock market is really volatile, you will typically see the price of gold go up. And so people think that that could be a nice counterbalance in their portfolio. The problem with gold is that the majority of times, the majority of years, the stock market is up. And when the stock market is up, because gold has such a low correlation with the stock market, that means gold is not performing so well. And so what you see is that even though during these short periods, relatively short periods of volatility, gold will be really outperforming the stock market, really over the long run, gold vastly underperforms the stock market. And so that's why it doesn't really make sense to be investing in gold, because it really leads to long-term underperformance in your portfolio.
Thank you, Natalie. We don't have any other questions yet. And again, if you have questions that you didn't want to ask or think about something later, please shoot us an email. We're happy to answer them. We're happy to arrange for a phone call if that's what you want. Jump on the phone real quick to talk through whatever it is that you're concerned about, or just have a chat. I found just making that voice-to-voice connection is also a good thing in self-care. So please reach out if there is anything we can do.